Everyone believes that bull markets make millionaires, and to a certain extent that's true, but it's what they do before the bull market starts that makes them a millionaire. And the last time that the stock market showed what we're seeing right now, everyday people investing steadily were the ones that walked away rich. Not because they guessed the next big winner, not by chasing the hype, but by following a simple, proven plan. Now today, we're setting up for the opportunity to shine. And I want to show you exactly what I'm talking about, because understanding this could change the way in which you invest forever and could very well change your entire future. Guys, we are in a precarious market right now. But by the end of this video, you're going to have exactly the plan that you need. That no matter where this market goes, up, down, left, right, you're going to set yourself up for riches as long as you follow a simple plan that has proven to work for decades and decades. We're living through one of the biggest bull runs in history. This is undoubtedly a fact. Markets keep hitting all-time highs. It's super exciting, but we have witnessed this many times before. And you know that excitement can be a double-edged sword. Back in the late 90s, people were sure the internet was a game changer. And guess what? It was a game changer. It changed everybody's life. If it wasn't for the internet, how would you be learning right now? But they made one critical mistake. They decided that price didn't matter, and they bought into the hype. Now, they didn't do that by actually saying price doesn't matter, but their actions and their buying patterns into stocks proved that that's what they believed. Valuations were insane. Everyone wanted to own stocks. Everyone was talking about getting rich overnight. When I was in college at the University of Michigan, I met a kid, and he was 3 or 4 years older than us. And finally one day I said to him, hey, why are you in our class and you're like 4 years older than me? He goes, well, I graduated high school in 95. The internet was taking off. I went and joined a brokerage, and I did that for a while. I go, oh, why'd you leave? He said, because the market crashed. I go, how insane was it? He said, Paul, we were literally pissed if we didn't make 200 or 300% an IPO in one day. Literally pissed. And I laughed. I was like, that's incredible. So yes, today's market is very overpriced. And yes, it will create a lot of millionaires on paper, but it's not going to happen for the reason that most people think. We all know what happened in 2000. The bubble popped, and it popped hard. The NASDAQ from March of 2000 to its low in the middle of 2002 fell nearly 80%. And when the stock market crashed, the people who bought the hype, the people who bought with no process, the people who bought without understanding what they were buying, they then became panic sellers. Because if you don't know why you're going to buy, you don't know why you're going to sell. What we're trying to teach on this channel, and it's really important, especially if you're new to investing, but across the entire gamut. The winners will take care of themselves. Successful investing isn't about finding the winners necessarily. It's about avoiding the big losses. That's what's really, really key here. We're trying to teach you how to look at balance sheets, how to look at financials, and we'll get there. But it's super important that you look at these signs of overpaying and bad companies. Last time stocks did this, everyday people became millionaires. It wasn't overnight. This is not a channel for overnight profit. If you're looking for that, we're not the channel for you. And I'm okay with that. You should be okay with that. But if you're interested in leveling up your intelligence, leveling up your investment game, and being somebody who can fish on their own, this is the channel for you, and this is the video for you. Now, also back in 2000, I remember being at a barbecue at a friend of mine, my dad's friend's house. He was a doctor in Canton, Ohio. And we were there and he said, hey, Paul, what are you interested in? I said, investing. He goes, oh boy, investing. He goes, I lost a lot of money in the market. I said, you did? And he was very open. And I still remember he was grilling. And I said, like, and I basically said, like, what happened? He goes, yeah, my internet.com stocks were up to like $5 million in my account. So of course, naturally being the 19, 20, 21-year-old, I said, well, what is it now? He goes, I don't know, 50 grand. And I was like, what? He goes, yeah, it's down well over 99%. I was like, he didn't even look anymore. That's what's interesting to me. Now, guys, I always say this. One of the tenets of principle-driven investing is, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And that guy invested probably a couple $100,000, became 5 million, felt on top of the world, and watched it fall 99%. Guys, in a short period of time, the voting machine said this is great. The voting machine said it was bad. To draw a more relevant analogy, for those of you who were around during 9/11, if you recall, Bush barely won the presidency. He had lost the popular vote. It was within the margin of error, but he won the Electoral College. And here's a guy with, at the time, around 50% maybe approval rating. Then 9/11 happened. And his approval rating soared to 92%. If the election had happened in November of 2001 instead of November of 2000, that guy would have won the election in an absolute landslide. He would have won probably 70% of the vote, which is an unheard of amount. That's a key there. When Reagan won in 84, he won 49 of 50 states, and he won 58% of the vote. So here's Bush. He would have crushed it. And guys, just 2-3 years later, he barely won re-election. Yeah, he won by a couple percentage points, but it was a tight one. In fact, the morning of the election against John Kerry came out roaring ahead. Exit polls were saying that John Kerry is going to win by a landslide. That's how fickle things can be. And by the way, in the long run, stocks are a weighing machine. If you go look at the approval rating for George Bush now from back then, it's well into the 60% range, well, mid-high 60s. Now, there might be other reasons for that. But the point is, in the short run, it goes wild. In the long run, it's more steady. Now, the people who benefited from that bull market were the steady investors, the ones who kept buying index funds in the early 90s and the 80s when stocks were looked at as kind of crappy, and they just kept building their portfolio and building it. And eventually, the explosion happened. And after the bubble burst, the people who kept on holding, who kept on buying good companies at better prices, even when stocks were going lower and lower, they were able to make outsized returns once the bull market came back. Because guess what, guys? The bull market eventually comes back. In fact, I say this in almost every video. If you bought the NASDAQ 100 before it fell 80%, if you bought at the very peak and dollar cost average today, you'd be over 14 or 15% annualized returns from then until now. And I do believe the NASDAQ's overpriced, but cut it in half, it's still over 11% annualized return. Now, fast forward to today. The signals are eerily similar. The stock market is overvalued and stocks are flying high. In fact, the most reliable metric in stock market history says that stocks are far more overvalued today than they were back then. Because our goal here, guys, you have to remember, is to buy when price and value are disconnected, when price is below value. But the key is to understand how to determine that value. Once you're able to determine that value, you're going to be unstoppable because you're going to be able to say, I know why I'm buying this company at this price. The market is going to set its price no matter what you're doing. It doesn't care what you paid for a company. Your job is to decide every single day, am I a buyer or a seller? Too many investors buy solely based on stories and hype. They forget the fundamental question. What's the fair price to pay for what I'm getting? That's why so many beginners get burned. And before you get burned, like I did back in the day, I want you to learn that lesson so that you can go forward and be ready for what's going to happen. I'm not telling you to sell everything. That's the last thing I would do. What I'm telling you is be ready for the next 5, 10, 15 years to not be as good as the last 10 or 15. That's okay. Because if you're still buying the right stocks, the right ETFs continuously, eventually there'll be a point when the bull market comes back and you'll make a killing. Let me repeat this over and over. Price is what you pay, value is what you get. If you don't believe that's possible, then you would never buy anything on sale. Then you never look for a good deal. You would never negotiate the price of a car. Now, what the problem is, most investors confuse price and value. They think if a stock goes up, it must be valuable. Wrong. That's just the market voting in the short run. But in the long run, it's about weighing the actual value of the business. Would you buy a Honda Civic for $200,000 just because everyone else is doing it? Of course not. But people do this every single day with stocks. Great stories can become horrible investments if you pay the wrong price. That is the fifth tenet of our principle-driven investing. Let me show the prime example that I love showing about the darling stock of 2000, Cisco Systems. This company was going to be the first trillion-dollar company. It was the most valuable company at $500 billion. Everybody said, this is the first trillion-dollar company. It hit $82 back in 2000. It has not hit that since. Now, what's interesting, guys, is from this point to this point, the stock is up 10x. Guess what its profit is up? 10x. But what happened in the short run? Boop, boop. What happens if you eliminate all this garbage that happened right here? How does this chart look? Pretty good. You probably look at this going, this is a pretty steady growth business. That's what I mean. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Now, most investors lose money because they're trying to pick the ones where the price is going to go up. Well, guys, that's impossible. The best investors do the opposite. They eliminate the losers first. And I teach this on YouTube because it's so important to me to go fight what I think is the bad stuff out there. The people telling you to fall in love with the story, to fall in love with price movements. Alibaba stock is up 90-some% this year, maybe 100%. Kathy Wood of ARK Investments just started buying it. Hey, Kathy, why weren't you buying it at $60 a share? Because she's not an investor. It's the exact same company it was at $60 a share, just the perception was different. So, what would you do if the market corrected tomorrow like it did in 2000 when valuations were really high? Well, here's what you should do. 1, stay invested, but be smart. No matter what the headlines scream, you've got to stay in the market with low-cost ETFs. Dollar cost average into them, into good ETFs, market-wide ETFs, by investing a fixed amount of money every month, week, whatever works for you. If you remove the emotional guesswork, this will build wealth over time. But don't chase the hype. You are probably not going to catch the next NVIDIA or Palantir by following some hot YouTuber's tip. That's gambling. That's not investing. Number 2, look at what you're buying. Understand what you're buying and buy great businesses at great prices. Now, a great price for a great business is probably a lot higher than an okay price for a fair business. Guys, when I look at a stock, I don't look at price charts at all. I don't follow hype at all. I look at it from a perspective of, if I were to own this business in full, if my neighbor came over and said to me, Paul, I own this business, will you buy it from me? What would I ask for? Financial statements? What the projections look like? How do they operate the company, etc.? Is their debt manageable? Do they have any debt? How consistently have they grown their revenue and profit? The last time there was a recession, what did they do? How well did they do? But at the end of the day, I'm going to sit there and I have to make assumptions about that future of that business. And I have to pay a reasonable price based on those assumptions. Now, it sounds like a lot of work, and it can be depending on what you look into. But I'm actually a big believer in repeating it over and over so it becomes second nature. If I'm able to find a price that's well below the value I need with ample margin of safety, that's when I consider buying. If not, I'm okay waiting. So guys, let's pick a stock. Let's go with a very popular stock now. What about Google? Google's been on a tear lately. $248 per share. Okay, a lot of great stuff here. You've got a market cap of $3 trillion. The first thing I'm going to do is I'm going to look at the balance sheet. Well, I'm going to compare the market cap to the enterprise value. This difference here is essentially their debt. So it's about $40 billion in debt. That's a lot. But guess what? Last year, they made $66 billion in free cash flow. So that tells me they can easily handle their debt. In 9 months, 8 months' time, they can pay off all their debt with their cash flow. That's a lot. That's awesome. That's incredible. And remember, guys, if you're new to investing and you hear me saying things now that don't make a lot, don't worry. It's about repetition and understanding. The key here is, do you want to get better at investing? Because I assure you, if you do this, you'll be further ahead than 99% of people in this world on investing. Okay, now let's look at their growth rates here. 3-year revenue growth, 10%, 5-year, 17.5%, 10-year, 18%. Okay, not bad. It's pretty solid. Doesn't mean they're going to do that in the future, though. But here's an important one I want to look at. Return on invested capital. This is a very misunderstood term. This basically means when they invest money in the business, when they have money invested in the business, what return are they getting? As an example, let's say you had a lawn business, and every time you bought a mower, you made 3% return on that. But you had to buy the mower, borrowing the money at 6%. Is that a good deal? You're borrowing at 6, you're making 3. That's a terrible deal. Now, you say, well, I'm not going to borrow the money, I'm going to pay cash. Okay, so you buy the mower in cash. Well, don't you deserve some return for your cash? What kind of return? 10%? Well, again, you're making 3, you're expecting 10. You're not getting good return. You can go to the bank and get 4.25. That's return on capital. This company gets 16.5%, getting better. Are they able to get more return from the money in the business than would be expected by the banks or other investors? If they can, they're generating wealth. If they cannot, they're destroying wealth. Now, let's go to our 8 pillars here. Remember, the 8 pillars tell a story. This story tells me right now that there are 6 checks and 2 X's, and right now the 2 X's are valuation driven. 5-year PE, 5-year price to free cash flow. Everything else is a check mark. They're buying back shares. We don't know that's good or bad yet, but everything else, revenue's up, net income's up, cash flow's up. One red flag. Revenue's up $200 billion. Net income's up $84 billion. Why is free cash flow only up $35 billion? Are they investing a lot of money in the business and that's why cash flow is down? Maybe. Because when a company invests money in the business, That doesn't get depreciated for many years. So it would make their cash flow lower because it's immediately cash out, but the IRS won't let them deduct that cash for several years. That's why net income's higher. You go to analyst estimates. Oh, analysts think this company's going to grow its profit 7 to 25% a year. Revenue is growing double digits. So then I go to my stock analyzer tool. This is where I put all of these things together. I take the information, I take the idea of like, okay, and by the way, I do this very early because the big thing is I don't want to waste my time analyzing a company that isn't even close to the value I want it to be. For example, if a stock is selling for 1,000 and I run Stock Analyzer and my best assumptions come up to 200, don't spend your time on it. It's still 1,000. Wait for it to drop. So let me pull up some assumptions I made in the past about Google. So I look at Google, and here are my revenue assumptions for the next 10 years. 5, 9, and 13%. Profit margin, 24, 26, and 28. Same with free cash flow. Now keep in mind, guys, they did 31% last year. Is this a trend that's going to continue? Is it going to slow down? Is it a fluke year? We don't know. Now, what PE would I assign to Google in 10 years? It's a premium company with high and increasing returns on capital, and they own the top 2 search engines in the world, Google and YouTube. It seems like a premium business. So instead of the market average of 15 to 16, I put in 20, 23, and 26. And finally, a 9% return. Guys, you should want more than a 9%. This is no margin of safety. This is just to say, what's the company worth? I hit the analyze button. Boom. Here's my price. I have a low price of 155, high price of 410, middle price of 253. So it's within the ballpark. I want to do more research on this, but this is how I do my process. It's very simple, but it's not easy. It will take you a little bit of time, but the more you do, the better you're going to do it, and you're going to be able to figure out what stocks to go spend time on. We're currently in a class right now where I'm teaching the foundations of our investing. And the thing I love is people have loved watching me look at stocks because I do it quickly and determine if I'm spending any more time or not as soon as possible. I don't want to waste my time following a stock that's selling for an insane price, and neither should you. There are plenty of stocks out there, and one person in the class today said, I did the numbers, didn't make sense, next. I was like, beautiful. Find the next one. Lesson number 3, guys. I really want everyone to follow the 5 tenets of principle-driven investing. These are tenets that I created, and their principles act like kind of guardrails that can keep me from making costly mistakes that can destroy my portfolio from probably buying the wrong thing or selling the wrong thing. They help me think more logically rather than emotionally, and I focus on facts and the future instead of feelings and making decisions based on short term. I want to make my decisions based on value, not momentum. That's how you avoid turning investing into gambling. So these 5 tenets are, the first one is we're investors, not speculators. We think of the long run. We understand what we're buying. We look at these things. 2, every investment is the present value of all the cash flows. I'm going to lay out money today. I'm going to get cash in the future every single year or so often. The more I pay, the lower my return. The less I pay, the higher return. 3, if we don't understand it, we do not buy it. That's the hardest one because when you see your friends making money in a stock that you want to buy because you want to make money, it's hard to sit there and say, but I don't understand this. I can't buy it. That's really, really important. 4, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. What's popular will go up and down, but the fundamentals of the business will drive the stock price. And the 5th, the most important tenet, a great story becomes a bad investment if you pay the wrong price. Now, instead of writing all that down, guys, very easy for you. Free download. Click the link below. We will email you this PDF within a minute or 2. You'll get it to your email. That way you can see more explanation about it, as well as have it in front of you ready to go. Now, guys, the one truism is the market will always have hype and bubbles. The question isn't if there's going to be a bubble burst. It's, are you going to be prepared for it? Because it will happen. And I'm going to level with you. It's really, really important to get this knowledge and skill now before the market turns. So in this next video, we're going to show you how we think and how we value stocks like all the greats like Buffett, Munger, and all these other great value investors so that you're prepared to act when others panic. The video is linked right on your screen, so don't miss it. This is how you get ready for the moment. Why do you need to get ready for the moment? Because great investing takes patience. It's not about quick flips. It's about long-term growth through thick and thin. Thank you for your time.